Ever wondered if you could measure the fear and greed driving the markets? Enter the put-call ratio, or PCR. This nifty tool tracks how many bearish put options are traded versus bullish call options. Think of it as reading the market's mood. When PCR spikes, fear dominates. When it drops, greed takes over. Traders fear what they don't understand. Let's break it down. First up, PCR basics, reading the room. Take WTI crude oil as an example. In March 2025, US shale output surged and PCR spiked to 1.8, a 12-month high. In April, OPEC Plus cut supply, PCR dropped to 0.6, and call options surged. The result? Crude oil rallied 18% in 2 weeks. Traders used PCR as a sentiment indicator to predict price movements. When PCR hit 1.8, it signaled extreme bearishness, hinting at a potential reversal. As soon as OPEC Plus intervened, panic faded, call buying surged, and prices reversed sharply. PCR extremes equal market turning points. Next, let's look at spotting sentiment shifts. Rate of change, or DPCR, adds depth. For instance, in January 2025, a polar vortex hit Europe and PCR dropped from 1.2 to 0.4 in just 10 days. By February, as the weather normalized, PCR jumped to 1.5 as traders hedged downside risk. Tracking how fast PCR changes reveals momentum shifts. As traders rushed to buy calls during the price surge, PCR plummeted. Once temperatures normalized, traders flipped, buying puts to hedge against the reversal. This rapid PCR change predicted the turning point before it happened. Momentum matters. Watch the PCR speed. But sometimes PCR misleads. For example, in March 2025, gold's PCR was at 1.5, yet prices rose. Why? Another example, Russia halted wheat exports, but PCR stayed flat. Why? PCR isn't perfect. It sometimes sends misleading signals. Gold's high PCR was because miners were hedging, not speculators betting against the price. And with Russia's sudden wheat export halt, options traders didn't have time to react, keeping PCR flat despite a major fundamental shift. The PCR isn't always right, it's a clue, not a crystal ball. Finally, PCR in action, the soybean trap. In February 2025, soybean PCR hit 1.3 amid Brazil export fears, and prices fell 10%. But in March, drought arrived, and prices rebounded 12%. The high PCR reflected farmers hedging, not trader pessimism. Once rains arrived, supply fears eased, and prices rebounded, showing that PCR alone isn't enough to predict commodity moves. Solution? Combine PCR with fundamentals like inventories, forward curves, and macro trends. PCR works best when paired with fundamentals. So, what's your PCR playbook? Extreme PCR hints at trend reversals. DPCR tells us whether fear or greed is accelerating. Always ask, is PCR driven by hedgers or speculators? Markets don't lie, but traders do. Use PCR to spot the truth. How are you using PCR in today's markets? Drop a comment below.